Hello, everyone. A huge warm welcome to you all. Thank you so much for coming to watch and listen to this breakdown. Today, we are stripping away the marketing gloss and looking at a company that claims to play by a completely different set of rules than, well, the rest of the stock market. We're analyzing Hermes International and their full year 2025 results. And look, usually when a company says they think in generations, not quarters, I kind of roll my eyes. It's usually code for, we had a bad quarter, please don't sell the stock.
Yeah, it's a deflection tactic most of the time.
Right.
But with Hermes, we have a stack of documents here, the earnings call, the Q&A, the financials, that suggest they might actually, mean it. We're looking at a company that just crossed $16 billion in revenue, yet they essentially refuse to ramp up production to meet demand. So is this ultimate discipline, or is it just leaving money on the table? That's what I want to figure out today.
It is the central question. They are operating in a global economy that was, frankly, a bit shaky in 2025, yet they delivered numbers that look like they exist in some kind of parallel universe. So before we get to the Q&A, which is where the sparks really flew, let's summarize the prepared presentation. This is from Executive Chairman Axel Dumas and CFO Eric Dulgit. Give us the headline numbers, but, help us understand the quality behind them.
Okay, so the headline is $16 billion in revenue, up 9% at constant exchange rates. But the number that really stops you in your tracks is the recurring operating profitability. It hit 41%.
41%? That just sounds incredibly high for a company that makes physical things.
It's massive. I mean, for context, most luxury brands fight tooth and nail to stay in the high 20s or maybe low 30s.
Right.
To sustain a margin of 41% at this scale is essentially saying that for every euro of sales, they're keeping 41 cents of operating profit.
Yes.
It's a fortress. They even managed to improve it.
And they did this even with that exceptional tax we've been hearing about in France.
They did. Even with a really heavy tax burden on large French companies, which pushed their effective tax rate up, net profit still climbed 5.5%. But there's a nuance here that Axel Dumas brought up repeatedly.
Yeah.
He described Hermes as a fixed cost business.
Okay, break that down for us. Why does that matter so much for the margin?
Well, it means their costs, mainly their highly skilled labor and their physical workshops, they don't fluctuate much. They aren't outsourcing to cheap labor that they can just cut when demand drops.
Okay.
So if sales were to dip, that beautiful 41% margin would crash pretty hard because the costs stay the same. It works both ways. They are betting everything on maintaining that top-line growth.
Which brings us to the human side of the report. They spent a lot of time talking about bonuses and wages. Is this just PR fluff, or is there a strategic play here?
Oh, it's entirely strategic. Think about their business model. It relies on selling, say, a bag for 10,000 euros. You can only do that if the quality is flawless. Flawless quality requires artisans who've been doing this for a decade. You cannot lose these people. So they paid a 3,000 euro bonus to all 26,000 employees worldwide.
Wow.
In France, they added a permanent wage increase of 120 euro a month. They hired 1,300 new people in 2025. I mean, while other companies were laying people off, Hermes was hiring.
So it's basically retention insurance.
Exactly. And speaking of spending money, they declared 2025 the year of craft. They poured $1.2 billion into operational investments, new leather workshops, more construction happening. They're just building.
They also mentioned vertical integration a lot. They seem almost obsessed with owning everything from tableware to watchmaking.
That's the key to their resilience. By owning the supply chain, they control the quality and they control the timeline. And if you look at the sales breakdown, that control is paying off. I mean, double-digit growth in Europe, Japan, the Americas, the Middle East.
But there were some soft spots, right? Asia, excluding Japan, grew 8%, which is good for anyone else, but maybe a little slower for them. And product-wise, perfume was down 8% and watches were down 2%.
Correct. Perfume struggled because of the travel retail, duty-free shops are hurting. But leather goods, which is the engine of the company, that was up 13%. And for any shareholders listening, they're proposing a dividend of 18 euros per share and are sitting on, get this, a net cash position of 12.8 billion.
Okay, that sets the stage perfectly. Financial fortress, huge margins, obsessively hiring craftsmen. Now, let's get to the fun part, the Q&A. This is where the analysts try to poke holes in the narrative. We're going to go through these question by question because the answers were surprisingly candid.
Let's dive in.
First up, we had a question from an unidentified analyst. They asked three things. First, trends for the start of 2026, especially Chinese New Year. Second, are stock levels too low? And third, this is the spicy one, they brought up, the Ferrari strategy.
Right.
Is Hermes artificially limiting production to create scarcity?
Right. And Axel Dumas jumped all over this. On Chinese New Year, He was very cautious. He basically said, look, the holiday moves around, wait for Q1.
Okay, a non-answer answer.
Pretty much. Regarding stock, they just said 2025 was a year of normalization and they're comfortable.
But the Ferrari comparison, that's the real question. Are they holding back bags just to make us want them more?
He pushed back on that really hard. He claims the scarcity is structural, not artificial. He talked a stat. It takes 16 hours to make a bag. But more importantly, he said they aren't limiting supply like a car maker might. They're limited by the time it takes to train craftsmen and find quality materials. It's a labor constraint, not a marketing gimmick.
That makes sense, but it also feels like a very convenient problem to have. Okay, next up we had Antoine Beck from BNP Paribas. He wanted to know about lessons from China. Is there an improvement? And he asked about price increases for 2026 and the margin outlook.
On China, management admitted, yeah, they are seeing improvement, but growth is slower than in the glory days. They noted a specific shift. The aspirational customers have dropped off a bit, but their high-value, top-tier clients are still excellent.
So the super rich are still buying, but the person saving up for their one big purchase is pulling back.
That's exactly it. On prices, they confirmed a hike of 5% to 6% in 2026. But they were very clear this isn't to pad profits, it's just to cover production cost increases.
A 6% hike still feels a little aggressive.
It does, but Dumas made a crucial point. We never drop prices because they never discount. They're extremely careful about raising them. He claims it's purely to cover input costs, labor, raw materials, gold. As for the margin, they warned that 2026 exchange rates look unfavorable, a potential hit of $200 million, but their hedging should help smooth that out.
Right. Moving on, we had Lucas Solka from Bernstein. He asked a big picture question. Is the middle class or aspirational client disappearing globally? And also about their jewelry strategy and what else they might buy for vertical integration.
This was interesting. Axel Dumas gave a strong defense of the middle class. He said they are not disappearing. He said they're strong in the US and Europe. The only place they're really struggling, he said, is in France.
That's a fascinating distinction. And what about the jewelry?
Yeah, this was a great little history lesson. He said they started with silver, then moved to gold because it was popular in humid Asian climates, and now they are really pushing haute bijouterie, the high-end stuff. He revealed that jewelry has actually been their fastest growing division over the last 15 years.
I had no idea. And on vertical integration, Luca asked, what else can be bought?
Dumas explained that they invest in suppliers mainly to protect them. So they've bought into jewelry partners, shoe manufacturers, really to preserve the know-how. It's defensive buying.
So if a supplier is at risk, they buy them to make sure the supply chain doesn't just vanish.
Exactly.
Next up was Olivia, identified as from Detroit Figaro. She asked about the store network in China, why perfume dropped, and this is the one I was waiting for, the launch date for haute couture.
On the China stores, Dumas emphasized a reasonable growth strategy. They have about 32 stores and they're opening roughly one new city a year. He stressed there's no stop-and-go policy, they just stick to the plan.
And the perfume.
He admitted it's suffering in duty-free. The strategy now is to focus on growing sales in their own stores instead of relying on travel retail.
And the haute couture, don't leave us hanging.
I loved this answer. Axel simply said, it will be ready when it's ready.
Of course he did.
They're building workshops, hiring seamstresses, but they refuse to rush a launch date. It is the ultimate luxury flex.
It will be ready when it's ready. I need to start using that. Okay, next was Thomas Chauvet from Citi. He asked about consumer behavior in China and also what they plan to do with that massive $13 billion cash pile.
The insight on China was sharp. Axel noted luxury spending there tracks for the stock market and real estate, the so-called wealth effect, not GDP.
So when people feel rich from their assets, they buy Hermes.
You got it. And he wasn't worried about local competition at all. He actually welcomed Chinese brands, saying it creates more market appetite overall.
And the cash, buybacks.
Nope, no share buybacks. They have a very strict rule of thirds. 1/3 for dividends, 1/3 for investment, and 1/3 retained for independence. They value that independence above almost everything.
Next was Antoine Belge from HSBC. He asked about their long-term growth algorithm and also their big real estate strategy, mentioning Rodeo Drive and Bond Street.
This response gave us the quote of the day. On pricing, he just reiterated it's to offset costs. But on real estate, Axel explained they don't want more stores, they want better and bigger stores. Regarding buying buildings like 166 New Bond Street, he said these are multi-generational plays. He explicitly said they were buying this for the seventh generation.
For the seventh generation. That is just, it's incredible. It sounds almost crazy to a Wall Street analyst looking at quarterly returns.
It does, but for a family-controlled company, it's the only logic that matters. They want to secure the best real estate in the world for the next 100 years.
Okay, next question was from Zuzana Puz at UBS. She asked why marketing expenses were lower, and she pressed on leather goods volume. Can you really sustain that 6-7% growth indefinitely?
So Eric Dulgett handled the marketing question. He basically said they aren't spending just for the sake of spending. Their current budget lets them do everything they want. No need to flood the zone with ads.
And the leather limits. This gets back to that scarcity issue.
It does. And they were blunt. They hired 250 to 300 craftsmen per year. And they flat out stated they cannot hire more because training takes too long. It takes 8 years for a craftsman to master multiple models.
8 years.
8 years. So training is the hard bottleneck. They can't just flip a switch and double production. That 6-7% growth is the physical limit of their training capacity.
Finally, we had Carol Maja from Barclays. She asked about the U.S. market. Is double-digit growth still possible? And she wanted a forecast for the 2026 tax rate.
Management was extremely bullish on the U.S., said it's performing incredibly well across all regions. Nashville, Scottsdale, California, they see no change in that trend.
And the tax man.
The exceptional French tax continues. The normal rate is 28.5%, but that special tax adds about another 5 points. So they're paying a lot, but it's not stopping them.
Wow, what a session. It is so rare to hear executives be that blunt about their own limitations while also being so confident about their future. So let's wrap this up. What are the main themes we should take away from all this?
I think there are 3 big pillars here. First is the long game. Whether it's ready when it's ready for couture or buying real estate for the 7th generation, they just refuse to be rushed. They're playing a different sport.
Absolutely.
Second, scarcity is structural. We learned today it's not a marketing trick. It's a labor constraint. You cannot speed up an 8-year training cycle without losing quality, and they just refuse to do that. And third, the financial fortress. That $12.8 billion in net cash gives them total independence. They don't have to answer to banks. They don't have to panic when the market dips.
It really highlights their resilience. I mean, doing well in China when others are struggling and absolutely booming in the U.S. It's a masterclass in luxury management. Thank you all so much for watching and listening to this deep dive into the Hermes 2025 results. If you found this analysis helpful, please do click like, share the video, and subscribe. Stay tuned for upcoming content.